Investing can seem daunting, but understanding the basics is the first step to financial success. In this guide, we'll explore 3 fundamental investment options: stocks, bonds, and mutual funds. Stocks represent ownership in a company. Stocks are bought and sold on the stock market, which is essentially a platform where buyers and sellers come together to trade shares or fractional ownership of publicly listed companies. Think of it as a marketplace for company ownership. When you buy a stock, you're purchasing a tiny piece of that company, which means you can benefit from its success or face losses if things go south. When you buy a stock, you're purchasing a small piece of a company. This means you have a stake in that company's success. If the company does well, so do you, as the value of your stocks may rise. However, keep in mind that stocks can be volatile. Prices can go up and down based on market conditions and company performance. The value of stocks fluctuates based on company performance and market conditions. Investors often choose stocks for their potential growth and dividends, which are regular payments made to shareholders from a company's profits. Next, we have bonds. Think of bonds as loans you give to governments or corporations in exchange for interest or periodic payments over time. They're generally considered safer than stocks, but typically offer lower returns that we also call fixed income. They are ideal for those seeking stability and predictable income, especially during economic uncertainty like we've seen ever since the 2019 pandemic. Then there are mutual funds. A mutual fund pools money from many investors to buy a diverse range of stocks, bonds, or other securities. This offers an easy way to diversify your investments without needing to select individual stocks yourself. It's a great choice for beginners who want to spread their risk. Managed by professional fund managers, they offer diversification and professional oversight. Mutual funds can be a balanced choice for investors who want exposure to various asset classes without directly managing individual investments. They cater to different risk appetites and investment goals,